Ladies and gentlemen, here we are again, continuing with advanced financial management. And the topic which we already started is capital budgeting. That is the topic number one in that syllabus coverage. And if you look at the coverage and the topics that we listed that we are covering, you see we have nine topics. And if you did not get a chance to view through the introductory video, that is when we started, when we introduced the whole concept of advanced financial management and the coverage. I would encourage you to go to the profile and review the video. It's there for free. Again, I would want to encourage you as followers, kindly check onto my YouTube channel, CPA Samuel Otieno. You'll be able to see lots of revision videos covering both practical accounting, business data analytics, advanced Excel, and many, many others, especially taxation. So I would encourage you to get to my YouTube channel, CPA Samuel Otieno. You'll be able to see lots of videos. If you're a CPA student or a BDA student, these videos are very helpful to you. Remember, these videos are in and around the profession of accountancy. So if you're a student and you're still learning in school, you will benefit a lot immensely from this. Again, as I had mentioned before, even if you did not see it, I would encourage you to go and check on it. I'd mentioned that even if you are pursuing your MBA, Masters in Business Administration, or you are taking your Masters in Finance, I'll tell you, and I believe you'll agree with me, that most of these topics that are outlined here under the coverage of advanced financial management, you will meet them in your syllabus coverage, and you'll realize that they cut across. Remember, the syllabus coverage under CPA is very comprehensive, and that's what we are covering. So even you don't have to be a CASNEB student. You may be pursuing your undergraduate degree in finance or accounting course, but you realize that these contents will still help you. Again, uh, Excel skills is non-negotiable. So if you don't have good Excel skills, or you want to advance your skills in that area so that you embrace more of Excel in your work, it will help you to manipulate lots of tasks at work. You can also join us so that we learn together. So we introduced advanced financial management. We started by capital budgeting, which is the first topic, and we gave it a very simple definition, which I believe you all were able to understand what we meant. Then we went and looked at the characteristics or the basic elements of a project which will be classified as a capital budgeting project. And out of the five elements that we were able to list, you realize that two of those elements come directly from the definition. So there is nothing new. It's very simple. And you realize that these are long-term projects. And the returns are realized in the future because they are long-term projects and they're highly risky. That is the third element which we discussed, involve huge capital outlay. And then we said that because these projects involve huge capital outlay, once you invest, once you put in your money, it might not be very easy to reverse. So that's why we say they are irreversible. They are irreversible. Then, interestingly, we went and looked at the types of capital budgeting projects, and I believe you still remember the examples I gave. Very simple to relate with, and they're within our daily operations. And I believe there is nothing complicated. Understanding is so easy there. We talked about mutually exclusive projects. We went ahead and looked at independent projects, dependent projects, divisible projects. I gave you very good examples, for example, rental house, then indivisible projects. So if you missed out on that first class, in fact, we've had two previous classes. So if you missed both the two classes, I encourage you to go and review them. They are there for free. In the YouTube channel, you get lots of comprehensive videos. And again, in our TikTok channel, you'll be able to get lots of videos. And the name is CPA Samuel Otieno. You will not miss out on that. Good. So let's look at the discounting techniques, and I believe you understand why we left non-discounting techniques for now, and we only concentrate on the discounting techniques. The difference, as I mentioned before, is about time value of money. So today, ladies and gentlemen, I want us to start doing the computational. How do we apply this knowledge? How do we do these project evaluation techniques? How will they help us to evaluate a project? Now we want to look at the practical application of these concepts, and that's what we are here to do today. And today we are going straight ahead. I'm not going to repeat the characteristics of an ideal investment appraisal method because we discussed them in details. What do you consider before you choose a method that you want to use to appraise or to review a project. So we will go straight ahead and look at these discounting techniques. And the first one, which we had listed in our list of discounting techniques, was discounted payback period. And as I mentioned before, that we are going to look at a past paper question so that we get to do it together and understand it best. Very good. So discounting techniques, discounted payback period. And I told you payback period simply means the period an investment will take to recover the initial investment. How long does it take you to recover whatever amount you invested in this project? That is what we call payback period, the time the investment is paying you back. Simple description. And I hope you understand that very easily. Very good. So let us look at May 2014. It's a CPA Advanced Financial Management paper, or which was done in May 2014. And we are looking at question number 2B. Question number 2B. So I will go ahead and open that question here. So allow me to pull down this screen, and then I share the next one, the next screen where we have that question. And I want to believe you are able to see it. Now, this is the question that we have. And you can see it is May 2014. That was an AFM paper, Advanced Financial Management, question number 2B. Look at question number 2A. Number 2A is saying, in the context of behavioral finance, explain Festinger's theory of financial cognitive dissonance. So that's a very interesting question there. But we will revise it, we will go through it and see how best you are supposed to respond to it. But today, I would want us to just look at part B because we are looking at discounted payback period. You know, it is normally good practice that if you want to master a concept, you learn about the concept, then you look at the practical application of it in form of a question. Once you get a question and you are able to apply that knowledge that you've learned on it, then you get to understand it best. So let us go ahead and look at this question here. And the question here says, Madara Limited is considering investing in one of the two mutually exclusive projects. I believe you now understand what are mutually exclusive projects. And the relevant cash flows of each of the projects are as shown below. Remember, mutually exclusive projects are competing projects. When you choose to go or to invest in one of them, the other one will automatically be disqualified. So that's what we mean by mutually exclusive projects. We talked about types of capital budgeting projects, and that was one of them. That was, in fact, it was number one, where I remember very well giving you an example of a school where they want to buy a school bus, and they have two options where they can either buy an Isuzu bus or which one do I give? I gave an example of a Nissan bus. So if they choose to go for the Isuzu, then that means they will have to forgo buying the other brand of the bus. So let us look at that. The relevant cash flows are given, and you can see the table given below there. The firm's cost of capital is given as 15%. Then you are told cash flows accrue at the end of the year. Cash flows accrue at the end of the year. And we have project X, we have project Y. Very good. Initial investments are also given. You can see for project X and project Y there. Then the cash flows are given from year 1 to year number 6. What is the required? What does the examiner want us to do? The examiner is saying, calculate for each project discounted payback period, 6 marks. Then Roman number 2, calculate modified internal rate of return, MIRR, 6 marks. Then Roman number 3 saying, calculate profitability index. And then that is 4 marks. So you can see that is totaling to 16 marks. If you add it to the 4 marks for question number part A, then you have a total of 20 marks for that question. Interesting, right? Good. So let us go ahead and look at the discounted payback period because that is the first evaluation method that we are discussing here today. So very fast, after we've looked at this question, I want us to pick it very fast, and the way it is, we run away with it. So I believe you've seen the question. Now, because you have to see that screen, I will drop it. I will drop this and then bring back our notes where we want to do the computation where we want to do the computation. Do I have the question paper here to make my work easy? I think I have it physical. Very good, very good. I have it here. I have it here. Physical paper, physical paper. So now it is saying very well that is considering investing in one of the two projects, and the project's cash flows are given. So what are we supposed to do? Let us go and ask ourselves, do we understand payback period? Yes, we do. I've just explained. Payback period is the time or the period it takes you as an investor to recover back the amount you invested in that particular project. That is what we call payback period. But now we are going to discount our cash flows first before we can do our evaluation to check at what period are we going to recover our money. Now, to do that, very first, I want us to come up with a table. And I believe as a finance management student, you remember we had discounting tables. In the introductory statement of this course, of this topic, we talked about discounting techniques. And I believe you remember very well that there is a difference between discounting and compounding. When you compound, you are looking for future value. When you discount, your interest is to get the current value because you are discounting from a future figure to a current figure. When you are compounding, it is from current to get the future. So we are going to apply that concept, and I want us to come up with a table, and that's how we are going to get the solution. And we are starting with the project number X, project X. That is the first project that we have. Remember, we are evaluating. You either choose project A or you choose project B, or project X, it is X and Y. So we are choosing between the two mutually exclusive projects. So write there period. We will write period. Then we go to cash flows. Then we come to present value interest factor. That is the discounting factor. And remember, it is R% and N periods. We are going to see how to apply that. And I believe you should already pull out your discounting tables. You should have it. Even if you don't have it, you can always get it online. That is a very easy thing to get. Then that will give us the present values. Once we have present values, we are going now to move from there. And I'm going to show you. I'm going to show you very easily. I think I've used a lot of space. I need to squeeze a bit so that we can easily fit in everything. I want it to fit in a good order so that we understand it best. We are going to discount our cash flows, then we look at the payback period. And I want to believe that where we are doing payback period without discounting, it is very easy because the cash flows, you just use them the way they've been given. So I said, we are starting with the first column where we are having the year. Then we are coming up with the cash flows that have been given there. Then we do the discounting factor, present value interest factor, R% N period. That will give us the present value. Then whenever you are doing a payback period, you are going to ask yourself, how long does it take to recover the amount of money that we invested in the first place? For you to do that, you are going to do cumulative cash flows, cumulative figures, so that as you accumulate, you ask yourself, how much have I realized in year number one? Then how much did I invest? How much more am I supposed to recover? So through that trend, you're going to easily track down until the point where you say, now, if I invested 30,000, I've already recovered 20. How much more do I need to recover? So this trend or this format helps you to easily get track and get the flow. So after getting present value, like I've just mentioned, we are going to do accumulated cash flows. Accumulated cash flows. We are going to accumulate the present values because we've already worked them down from future to present. Then we are going now to get I don't know whether to call it accumulated cash flows. If I use the word cash flows, I don't know whether it will confuse somebody, but let me just say accumulated present value so that someone does not get confused. Someone does not get confused like that. Very, very good. Very, very good. Very, very good. This is just a very, very simple table like that. You write year one, year two, three, four, five, and year number six. There are 6 years there. Then the cash flows as was given in the paper, I can see initial investment is 38,500, but here we are talking about the cash flow, so we don't bring on board initial investment in this table. So we start from the cash flows, and cash flow for year number one, I can see it is 25,000. That is for project X. Remember, we are starting with project X. Then the second one is negative 11,000. I'm using parentheses there. Then for the third year, it is 20,000. Fourth year, it is 15,000. Fifth year, it is 6,000. For the sixth year, it is 5,000, like that. Then we now want to go to the discounting factors. Remember, we were given the discounting rate. We were told the firm's cost of capital is 15%. So you see this R percent. This R percent is now 15. That is the discounting rate. So I will just replace it and put there 15%, 15%. So grab your discounting tables very fast. I will grab mine. I just want to believe that you know what discounting tables are. So if you do not know what discounting tables are, do not worry, because I'm showing you what discounting table is, how it looks like. So check on your screen, check on my screen here. You're able to see what a discounting factor is. Discounting table is, and we have the figures there you've been given. This normally comes at the back of the question paper, or if you are revising and you don't have your question paper, do not have it, you can simply Google it, you'll get it. So we are looking at 15%. You see, how do you check on discounting? How on these discounting factors? You look at where 15% is. You can see 15% is here. Then we look at the period. So year number one at 15%, the discounting factor is 0.8696, right? So we are going to pick that. Then for year number two, at 15%, it is 0.7561. Year number three, it is 6.56575. Year number five, it is 0.57, 0.4972. Then year number six, it is 0.4323. Those are the discounting factors that I would want us to pick. I hope you've understood how to read the table, because if you don't read the table correctly, you're going to miss the point. If you use a wrong discounting factor, then you're going to miss it. But don't worry again, because even if you don't have the discounting table, you can be able to come up with the discounting factors on your own, so long as you round it off to 4 decimal places. Let me show you how to do that again, because you must always have alternatives. What if one does not work? What do you do? So let me show you. I believe you are seeing my screen there. So how we get the discounting factors, if you don't have the table, or if you want to confirm what the table has, you can also open your Excel. Through Excel, it becomes so easy, because at the tap of a button, then you already have your discounting factors. But again, worry not. Just grab your calculator. From your calculator, you will be able to see it very, very well. Just use 1 plus R bracket raised to negative n. That is the discounting factor. That is the present value interest factor that we are going to look at. So I want us to start confirming the first one for year number one. Just open a bracket, say 1 plus R. What is our R? 15%, so 0.15. Then I close bracket, I raise to power negative 1. Negative 1, yes. So once I do that, I tap on the equal sign, and I'm getting 0.869565217. But I told you, if you want to get the discounting factors, make sure you round it off to 4 decimal places. So I will bring my discounting factor to 0.8696, like that. So you can see that these things, you can even work them out if you don't have the discounting table. So you don't even have to worry about the discounting table. Whether you have it or not, you're still good. You are still very good to continue. There we go. So we move. So we do again for year number two. So if you want to do for year number two and you've already keyed it into your calculator like this, you don't have to delete everything. Just use these navigating buttons. Go and change the years only. Remember, discounting rate remains constant, which is 15%. So I would just go back here and now change the negative 1 so that I replace it with negative 2, like that. Then I click on equal sign. I'm getting 0.756143 and all that. So I just pick it in 4 decimal places, 0.7561, like that. Then I do the same for the year number 3. Just replace the negative 2 with the negative 3, and I say 0.6575, like that. Then for year number 4, I also replace negative 3 with negative 4, and there you go. I have 0.5718. Remember, I'm putting them down into 4 decimal places. I'm rounding off to the nearest, to the nearest 4 decimal places. Then I also replace -4 with -5, and I'm having my discounting factor as 0.4972, because this is 49, 71, 76, 735. But into 4 decimal places, 0.4972 takes it. Then for the last year, year number 6, we do the same, and I'm getting 0.4323. They're the same discounting factors that you were able to see from the table that I've just projected. So remember, even if you don't have the discounting table, worry not. Calculator is enough to get you all those figures that you are looking for. So very good. Once we have that, now we go ahead and multiply the discounting factors with the cash flow, so that we get the discounted present value, the discounted cash flow. So I would start with year number 1, where we're having a cash flow of 25,000, multiplied by the discounting factor, which is 0.8696. What am I getting? 21,740. I do for year number 2, negative 11,000. I multiply by 0.7561. What am I getting? I'm getting negative 8,317.1. It is negative, that's why I'm using a bracket there. Then for year number 3, it is 20,000. I multiply by 0.6575. And there you go, I'm getting 13,150. I do the same for year number 4, where we are having 15,000. I multiply by 0.5718. What am I getting? 8,577. Interesting. Then we do for year number 5, 6,000. Multiply by 0.4972. What am I getting? 2,983.2, like that. The final year, year number 6, we are taking 5,000, multiplied by 0.4323, like that. And what am I getting? I'm getting 2,161.5. Interesting, like that. I hope you are seeing what I'm doing here, and you can also do the same on your end if you are following, so that you confirm and you see how do we use discounted payback period to compute, or maybe to evaluate and select which project is viable. That's what we are doing here. So now, after I've done this, I'm coming to now accumulate these present values. How do I do accumulation? For year number 1, it is the same figure, 21,740. When we come to year number 2, now add 21,740 to the cash flow in year number 2. But again, remember, it is the discounted cash flow. Do not come back to use the cash flows which were not discounted, the cash flows you were given in the table. We are now using the discounted figures, and that's why we call them the present values. So 21,740, we add, but remember, it is negative 8317. That is the discounted present value for year number 2. Negative 8317.1. That's what we are adding. It's like now we are deducting. And what am I getting? I'm getting 13,422.9, like that. We go to year number 3, and it is the same figure, what we've gotten. Because we are doing accumulation, we are adding that to the cash flow, this present value in year number 3, and we add 13,150, like that. I'm getting 26,572.9. Again, onto it, I'm adding the present value for year number 4, 8577. I'm getting 35,149.9. Onto it again, I'm adding the present value for year number 5, 2,983.2. What am I getting? I'm having here 38,133.1. Onto it again, we add the last year's present value, 2161.5. Very good. Very, very good. 40,294.6. Very good. Now, just hold it there. Hold on there. I want to show you something. Remember the definition of the payback period which I gave you? I said payback period is the period it takes an investment to give you back, or to repay you back the amount of investment. The amount of money that you invested, you are looking at what point am I going to recover it? That is the essence of payback period, and you're going to look at the discounted. Now, I want us to look at the question. The initial investment was 38,500. That is the initial investment, 38,500. So with that initial investment of 38,500, we want to see, At what point are we recovering it? And I want us to concentrate on the accumulated present values column. Accumulated present values column. Why are we looking at accumulated present values column? Because we've accumulated the cash flows that we are getting each and every year. And we've accumulated them, the present values that have been now discounted. That's why we call it discounted payback period. So from at the end of year number 1, how much are we recovering? Only 21,740. And remember, we invested how much? We invested 38,500. At the end of year 2, we are only able to recover 13,422.9. It is still not enough. We've not recovered what we invested. At the end of year number 3, it is 26,572.9. We have not yet recovered our investment. We go to year number 4, 35,149.9. We are very close to recovering the amount of investment. How much did we invest? 38,500. If we go to year number 5, we are going to recover 38,133.1. And remember, we invested 38,500, meaning we are yet to recover the remaining bit. And the remaining bit is the difference between 38,500 and 38,133.1. Now, it begs the question, how do we now compute the payback period? We know already, let me change this. We know that our payback period falls between year number 5 and year number 6. It is in between here because we are recovering 38,500. At the end of year number 5, we've recovered 38,133. But at the end of year number 6, we will recover 40,000. So meaning when we go to the cash flows in year number 6, we're going to get more than what we invested. But we only want to look at the exact period we are going to get back our investment. You get that? Because after we've gotten our investment, that is the point where now we've fully recovered the amount we used in this project. Then now from there moving forward, now we are getting into the profit zone. And in some other quarters, which we're going to discuss, that is the point where we say you are breaking even. If you're a business person, when your expenses, but in this case, we're not talking about expenses, but we're talking about investment. Now, if that amount of what you've invested, what you've already used, is equivalent to what you've gotten back, that point in some other quarters when you talk about expenses and profits, or maybe the amounts you are getting to recover, the cash flows, then we normally say that is the break-even point. Yeah, the point when you are breaking even. You're not making a loss, you're not making a profit. But because this is a different perspective, we are talking about investment. We are not talking about expenses. This is now investment. That is the point when we recover our amount. And from there, now we are getting the cash flows that we are realizing as returns from the investment. So what formula are we going to use? What formula are we going to use? I want to go to the next page so that now we see. If I look back at the question that we have. The question was saying very well, we select after we have project X and project Y, and we are told using the discounted payback period, we are supposed to choose which project to pick or which one is more viable. So here, I want to give you a very simple and direct approach. I want to give you a very direct approach, which we are going to use to do this project evaluation. And this project evaluation is going to help us to identify which one is more viable than the other. Yes? Which one is more viable than the other? Sorry, I'm just getting some power here. Now, so the approach that we're going to use is very simple. We are going to use, to get the payback period, the period we are going to take to recover back our investment, it is very easy. We are going to take the period that we've already looked at. I want you to check back. At what point did we say that we're going to recover the amount? We're going to recover it between year 5 and year 6. So at the end of year 5, we've already recovered 38,133.1, but we are looking to recover 38,500. So we already know that we are going to recover it in 5 years and some months, right? It is in 5 years and some months. So what do? We go there and say our payback period is 5 years. 5 years like that. But it is not just 5 years. It is 5 years plus a fraction of year number 6. A fraction of year 6. so that we go to year 6, but we do not pick all the present values or the cash flows in year 6. We just pick a bit of it, part of it, so that we recover the top-up amount onto what we already recovered up to the end of year 5. So what do we do? How do we get the fraction? To get the fraction, we are going to compare. We just pick the initial investment amount, the initial investment, because that is what we intend to recover, initial investment. And once we pick the initial investment, we deduct the lower limit. We call it lower limit. We deduct the lower limit, and I want you to introduce some bracket here. Then whatever amount we've gotten as the difference, we divide by upper limit minus lower limit. Lower limit, like that. This bracket, in fact, should cover everything. This bracket should cover everything. I made it a bit shorter. Like that, like that. That gives us the fraction of year number 6. And remember, because we are going to get it in months, it is less than a year, we are going to multiply this by 12 so that we get what fraction of year number 6 are we going to use to recover back the amount that is remaining. So we go there and say 5 years plus. Now, what is the initial investment? We invested 38,500, right? 38,500. Then we deduct lower limit. How do you get the lower limit? I want you to check. Let me get back to where we were. Lower limit. What do we mean by lower limit? Lower limit, if you look at our tabulation of the accumulated present values, you see we are recovering our figure between year number 5 and year 6. So at the end of year 5, we have 38,133, but we are looking to recover 38,500. At the end of year 6, we have 40,294, which is above what we are looking for. So if it falls in between, whatever cash flow we get at the end of year 5, we call it lower limit. Lower limit. And whatever we are going to get in the next proceeding year, that is year number 6, we call it upper limit. So that's how we identify the lower and the upper. So you can see from here, our lower limit is 38,133.1. Upper limit is 40,294.6. So let's go and insert them. Let's go and insert them. So lower limit, we've just said there, it is 38,133.1. Then we divide by upper limit. What was the upper limit? Let me just refer. Let me refer to the upper limit. Upper limit, we got 40,294.6. 40,294.6. We deduct again lower limit, 38,130. 38,131. Was it 38,131? 38,133, sorry. 38,133. 133.1. 133.1. Then we do, okay, it ends there. It ends there. We close this bracket like that. We multiply by 12. So that is the fraction of what we're going to get from year number 6 to fully recover our initial investment. Interesting there. Good. So let's get the difference very fast. 38,500, that is the amount we're going to recover, minus the lower limit, 38,133.1. What am I getting? Numerator, I'm having 366.9. Then I want to get the denominator, 40,294.6 minus 38,133.1. What am I getting? 2,161.5. Whatever we are going to get here, we multiply by 12 to get the fraction of the year there. So it is 5 years plus, that is 366.9. We divide by 2161.5. I'm getting 0.1697. I want to multiply by 12 because we are getting the fraction of the year, which is the months. So we are getting 2.04. 2.04. So actually, if you talk about 2.04, then it is 2 months, 2 months, 0.04. But now I want us to stop at months. So we will have to now round it off to the nearest whole number, because we only need to go to the level of months. We want to go to number of days or maybe hours and all that, and seconds and all that. So we just stop at number of months. So it is now clear to us that our investment of 38,500, we are going to recover it in 5 years, 2 months. So the payback period is 5 years, 2 months, like that. 5 years and 2 months. That is the period it will take us to recover our initial investment of 38,500. So ladies and gentlemen, I hope you've understood how to go about the discounted payback period, and I'm glad that you've made it up to this point. And again, if you want to make sure that you don't miss any of these videos and any of these lessons, kindly, I want to ask you diligently, please, please, please subscribe, follow, and share. Subscribe, follow, and share so that you can always get notifications whenever we post such videos, and people can also enjoy, because when you share and you subscribe, it will get to some other person who will watch and also enjoy the same. And I would want to ask you again to follow my YouTube channel. My YouTube channel is CPA Samuel Otieno. CPA Samuel Otieno. And by the way, the good news is when you get to this YouTube channel, you will get to see lots and lots of videos. We have hundreds of videos there, and they are discussing several concepts on the accountancy profession, advanced Excel, business data analytics, taxation, practical accounting, a lot of concepts put together, and you don't want to miss any of them. So kindly go there and subscribe, share, and like so that we can always get this moving. Thank you so much for making your time and looking at this class. In the next class, we are going to look at how do we get the payback period for project X. We've project Y. We've done for project X. We're going to do for project Y the same way, using the same approach. Then at the end of the day, we are going to see which project is more viable than the other. So we are going to make a decision. And this is a discounted payback period as a discounting technique for project evaluation or project appraisal. Thank you so much. See you in the next one. Thank you so much. See you in the next one. And I believe you've enjoyed. In case you have any questions relating to our contents, in case you want to make any inquiries, do not hesitate. Reach out to us and make sure we get you covered, because we are here for you.